a 3, 2, 1, buy down. What is that? It sounds like a CrossFit workout countdown, and I'm getting ready to.
On your mark, get set.
What's up, everybody? This is Luis. Hope you are all having a wonderful day. In this video, I'm gonna break down what this 3-2-1 mortgage interest rate buy down is all about and how to calculate the cost. All right, let's do this. On a real estate purchase transaction, a 3-2-1 buy down is where typically the seller issues a seller credit to buy down the buyer's rate for a period of 3 years. And it works like this. Assuming the interest rate is 7% today, and a 3-2-1 buy down will reduce the rate down by 3% the first year, 2% the second year, and 1% the third year. After that, the rate will go back to the 7% for the remainder of the loan term, which is typically 30 years. So what does this mean in actual terms? So let's take a $1 million purchase with 20% down with a rate of 7% interest rate and a 30-year fixed loan term. $800,000 is the loan amount. And let's look at this interest rate reduction amount. So this is first year 3%, second year 2% reduction, and 1% the third year. All right, now proposed interest rate, next column or next row down, proposed interest rate is 7%. So remember, the first year we're going to subtract 3%. So 7 minus 3, that's 4% interest rate. And then the second year, we're only going to reduce 2%. Remember, 3-2-1. So the interest rate is going to be 5. And then finally, the third year, we're only going to reduce the interest rate by 1%. And that brings it down to 6% interest rate. Next, let's take a look at the payment. Payment at 7% is $5,322. Well, the first year, because of the rate reduction, it's going to be $3,819. Second year, because of the rate reduction, it's going to be a little under $4,300. And then finally, third year, a little under $4,800. And then finally, years 4 through 30, it's going to go right back to the $5,322. So the strategy behind this setup is to refinance the loan before the 3-year mark at worst, preferably the first year. This setup is very helpful and is huge because it will allow the borrower to keep the payments low, and when the time is right, refinance right out of that high interest rate loan. So how much does it cost? Well, to calculate that, we are simply going to take the difference in payment for the first year. So the first year, it's $1,500 a month times 12. That's $18,000, a little bit over $18,000. Second year, the payment difference is $1,027 per month, and that adds up to a little over $12,000 for the year. And then finally, the third year at that 6% interest rate, it's $526 per month, and it is about $6,312 for the year. So we're going to add all 3 years up, and we are going to get our grand total of a little bit under $37,000. So this would be the total credit needed from the seller. This is basically the amount that you will ask the seller to issue a credit for during your negotiation. Pretty simple, right? I mean, that's it. There is not much more to it. And with that, that is all I have on this short video. I hope this information is useful, and reach out in the comment sections if you have any questions. Don't forget to hit the subscribe notification button, and thank you for listening. Thank you for watching, and I will talk to all of you in the next video. Bye.